Hey, what's going on, everybody? Welcome back to another episode of Wealth Defense Radio, the podcast. I am your host, Josh Inahosa, and I am an independent advisor representative for SWAN DFW. That stands for Sleep Well at Night, Dallas, Fort Worth. And I am here with a man that would never put a cast iron pan in the dishwasher. It is Hector Inahosa.
Good morning.
Hector is a certified financial planner, which is the top mark in our industry. He's been doing this since 1993.
Yep.
Moved up here in 1995, and Swan is a little over 11 years old as we record
11
this
and a half
episode.
now. Man.
So, I'm excited that I nailed all of that without reading any of it. Today, we're talking about why trying to time the stock market doesn't really work.
That's right. It started with me hearing something that I've heard for a long time. Sell in May and go away, and we'll talk about what that means. And it's just another market timing thing, and we'll show you how it maybe not the best idea to do in the whole world.
Yeah, that'll
Hopefully.
come in just a minute. But first, wherever you're listening, give us a like, subscribe, turn on notifications so that you know when we post an episode, whether that's on YouTube or Spotify or wherever it is that you have found us. Facebook, just deep on the internet.
on the dark net.
Wherever it is you have found us.
Yeah, and share the episode with somebody who I don't think anybody would like our humor, although I seem to kind of like it, but maybe some of the content might make some sense for them. So
So, before we get into this, Hector has our news story of the week.
Yeah, a couple of episodes ago, we talked about how in Turkey they decided some city, what'd you call it? Lice turkey. They decided to burn all of the pot that they had found. And of course, everybody got high and sick. And in Turkey somewhere, likely not the same city, but seems Turkey is making our episode a lot. A young man went out and got himself intoxicated, so intoxicated that he walked out of whatever tavern he was in and got himself lost and was in, it sounded like some woods or something, and he passed out. And when he came to, there was a bunch of people on some kind of search and rescue thing. And so he joined them because he wanted to do a good thing. And it wasn't until several hours later, the newscaster said, like maybe more than 6 hours, that he finally realized that the search and rescue party that he had joined was looking for him. So, good news, bad news. Good news is you found me. The bad news is you found me 6 hours ago. I just didn't know you were looking for me. So, I'm sure that he was the hit of the city that night for wasting people's time. But at least he's safe and sound, and we'll probably never have another drink again because we know how we learn our lessons very, very quickly.
Yeah, I guess my question to you is if you're the guy that joined the rescue party, say you, Hector Inahosa, you wake up in the woods.
Yeah.
Somehow.
I've done that.
Yep. After a long night. There's a search and rescue party. You don't know who they're looking for. You join. They're looking for you. You're like, oh, they're looking for me.
Yeah.
How do you break that news to people?
See, that's just where I would not have broken that news. What I would have done is run ahead of everybody and then lay down like I had been, stricken by lightning and let them find me.
Okay.
Except by then they probably had put a name tag and a vest on me. But anyway, I don't know. I don't know that I would have had the gumption to say, "Oh, wait, hey guys, it's me you're looking for." So there you go. The moral of that story is don't join a search party unless you know who they're looking for, and if they're looking for you, go ahead and fess up right now.
Yes, a lesson that we all could use in our daily lives.
Comes up a couple times a year, I think.
Yeah. So let's move on to another lesson that we could use. Hopefully more.
I like the translation.
Yeah, I know.
That's very good.
Like I'm a trained professional.
Almost, yes.
let's move on to that. So we're going to talk about market timing.
Yep.
Doesn't really work. It's hard for everybody. It's hard for people that are not in the finance industry. It's hard for financial professionals.
Right.
It's just difficult. It's not something that you really want to do.
That's right. It's a fantastic way of losing a lot of money very quickly. How's that?
Yeah.
And so it started, I was listening, and they said, well, just remember the old adage, sell in May and go away. And so the premise of that is that most people think that nothing happens in the summer between May through maybe August. So the big market moves have come in September through April. Kind of what the thought was is that in May, most of the big traders, most of the people that run the big institutional funds and stuff like that do go on vacations. And some of them are long vacations, and they'll go to the Hamptons, or they'll travel around the world. And so they'll be gone for a long time. And that leaves the junior traders there. And junior traders are usually told, don't buy anything unless I call you. But if this thing hits this stock hits this benchmark, sell it. So you got a bunch of people sitting on desks that can't buy, but all they can do is sell. And that's what sometimes leads to things going down. And so, yeah, that's where the idea came from, is you sell in May and go away and then come back sometime in September, October. And the research shows that you will have missed some nice returns in that time. On average, between 2000 and 2024, they've been up at 1.4% in that time frame. And in the last 8 out of 10 years, they've been up 4.6%. So you could miss a pretty good move if you take that adage, which got me thinking, maybe it's been a while since we talked about market timing as general. Maybe we talk about what it is and why it doesn't work. But that's what started this. So don't sell in May and go away.
Yeah. I think timing the market is just difficult. It feels like something that would be easy to do.
Oh, yeah.
Because you're like, oh, if the market's... I'll just sell right when it's about to go down.
Yeah.
And then I'll buy right when it's about to go up. And that in a vacuum is a great idea. However, it doesn't generally work that way.
It doesn't for a lot of reasons. It's funny when we're having meetings with clients and reviewing, and sometimes we'll show them a graph of a particular stock or maybe their portfolio, and they say, gosh, why didn't we just sell when it was at 200 and hold cash until it came to 150 and then rebuy it then? Well, because when you're looking at a historical chart, that's really easy to look at. But trying to foresee in the future, that's a little tougher. You've got to make two great calls. The first call you got to make is, okay, this thing has hit, like you just said, has hit its peak and it's going to start downward. So let's sell now. And then if it does go down, then you got to decide, okay, when am I going to get back in? Because what if it keeps sliding after you get in? And so those, even for professional traders, these are very, very difficult things to do. And so for folks that are just doing it, spending an hour or two every day doing their research, it's near impossible. So
yeah, so it's hard even for professionals.
Yes.
Again, to really hammer that home. It's not something I think anybody should recommend trying to do.
And when we say professionals, I'm not talking about us. I'm talking about like traders that trade not only their money, but millions of dollars for hundreds of thousands of people sometimes. It's hard for them to time the market. And if it's hard for them, it's impossible for us that do some research but don't have the research budgets and stuff that those people have. So
yeah, doing that, obviously you're going to miss out on some gains. I think Hector has some stats on some hypotheticals.
Yeah,
it helps put it into perspective what that actually looks like.
Right. By getting out of the market, right? But by just saying, okay, I'm going to sell in May and go away, or I'm really scared of the market. We've had some people that said, I'm really scared of the market 4 or 5 months ago. They said, I'm really scared of the market. I want to get out of the market. And they've missed a pretty good move because they had stayed out of the market. Once you get out of the market, it takes a lot of courage to go back in. Going back to Wall Street, fear and greed are the two things that drive the market. And if fear got you out, fear is going to keep you out. Yeah, this article comes from CNBC, and it says the cost of missing the market's best days. Let's say we put $10,000 in the S&P 500 on January 3rd, 2005. And left it there until December 31st, 2024. So we put 10 grand in. 19 years later, we come back, and it's worth $71,750. That's a 10.4% rate of return. That's really good. Anytime you get into double digits long term, you've done something right. Yeah. But what if we only missed 10 days out of, you're good at math,
5,700 days.
Okay, you got 5,700 trading days, más o menos. That's more or less for those of you that are not bilingual. And you missed just the 10 best. Those returns, that you put the same 10,000 in for the same amount of time, but this time when you come back, instead of being worth 71,000, it's worth 32,000. Because the market doesn't move a little bit every single day. It moves a little bit, loses a bit, moves up, and then it has a big hit. Mm-hmm. And if you just miss those days, if you happen to be out of the market on those days, and nobody calls you and says, hey, tomorrow is going to be a big day, make sure you're in the market. They just happen. And sometimes they start happening early in the morning, and it's a whole day thing. But sometimes it's in the last 2 or 3 hours of trading that something happens during the day, and you have a big hit. So that's a substantial, that's less than 50% total, 71 against 32. So again, moving out of the market, is not, trying to time the market is not a good strategy. It's just not. Tried it, and I'm proof positive it doesn't work. Way back in my early days when I thought I was way smarter than I really was. It's a good way to lose money.
This was before he was a certified financial planner, which is the top mark in our industry.
And then the original Greeks, the smartest people in the world. Most people don't know that.
So, if we're not investing to try to time the market and do like day trading, would you say that it's safe to say that a better plan would be a long-term strategy of buying a stock and holding a stock and getting good companies?
Right. And that's our kind of our premise. We're not a 100% buy and hold, which means once we buy a stock, we're never going to sell it, because we do from time to time move out if we don't like the story anymore, or if there's a change in management, or if there's a financial change, something happens either with their audit, that they find themselves in a cash short situation. We do move out of stocks. We don't sell out of a lot of stocks. We've moved out of few. We moved out of, for instance, Boeing, 3 years ago when they were having a really hard time keeping their airplanes in the air. We thought that's probably not a good thing. And then Chipotle, after the stock split, has been flat for a period. So one of our favorite stocks, and we're out of it. Doesn't mean we're going to be out of it forever. It's just going to be, we're going to be out of it until for instance, we're working our way back into Boeing now. The president did a really nice job of selling out a lot of their airplanes. And so some of the stocks we get out, we still look at them. And when their story changes, we'll come back into them, or we'll find a different company. So, but yeah, we're going to buy quality companies in the portfolios. We're going to like their cash positions. Their financials are going to look good. Their management will be really good. They're in the right sector. And they're one of the leading folks in their sector. And those are the kind of companies we want to buy and hold. And, right now, technology and especially artificial intelligence is where we are. But if we'd have been back in the 1940s, 1950s, when all our men were coming back from World War II and they were all like buying homes and cars, I would like to think that we would be buying car manufacturers, and home builders, because that was what the market was telling us was happening. And so right now, technology and artificial intelligence is where our future is, and we want to be on the ground floor of that.
Now, Hector dropped a lot of actual company names. None of that is investable advice.
Yes, it's not actionable. I just wanted some clear-cut examples. Don't do anything until you talk to a financial professional, and preferably one of the smartest people in the world, somebody at the top mark of their deal, and maybe works for Swan DFW Financial Solutions.
Or owns Swan DFW
Even
Financial
better.
Solutions. And if you want to talk to that guy...
or anybody on our staff.
We have a couple different ways that you can do that. The first way is via phone number, and that is 888-SWAN-DFW. Wow, what a clever phone number. What is that in actual numbers? 888-792-6339.
I should probably remember that one day.
Yeah, that would be awesome. Probably. And our email address is info@swandfw.net. All of that will be in the description wherever it is you're watching or listening.
And the next person that sends us a email to that info@swandfw.net, even if they don't ask a profound question, we'll send them a gift card to Starbucks, which, by the way, you can buy a cup of coffee. And I have to, it's a very complicated order, but I finally found something I like. It's only like $7 a cup. A small cup.
Yeah, Hector has figured out his Starbucks order, and he loves it so much he does not know it. He has it written down, and when he gets to the cashier order, he just holds their phone, his phone.
Says, can you fill that? And they go, yeah, who's this for? It's for me. But we digress.
Yeah. So anyway...
we also mentioned Starbucks, and not an actionable stock to own or buy. Just make sure you check with your financial professional. We neither endorse nor condone any of the stuff that happens on this program.
Well, I think you have to endorse the stuff that happens on this program. It's your program.
Oh, yeah, I forgot.
We'll talk about that off the air. Thank you guys for listening. We'll catch y'all in the next one. Take it easy.
Thank you. God bless.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.